this every day, so it shouldn't be too big of a deal.
Are you busy with these days for loans?
Very, very. Yeah, I'm real busy. Real busy. You know, a lot of purchases, a lot of refis. I mean, I'm about 50-50 right now. I've got a lot of purchases going on, but there's a lot of refis going on as well.
Oh, a lot of people are
Oh,
refinancing, right?
oh yeah. Yeah. I've never seen the rates this low before.
Huh.
In 30 years, I've never seen them this low.
It's interesting, right?
Oh yeah. It's interesting.
What was the prime today?
Oh God, I don't even know what prime rate is right now. We don't really look off prime. That's more commercial
Okay.
type stuff. We'll do off that. But you know, like we look at treasury bonds and stuff like that, and they're below 1%. So
Wow.
it's unbelievable. I mean, I were looking at 30-year fixed rates today at under 3%.
Really? Under
Yeah,
3%. Wow.
yeah. If you have good credit, you got to have good credit. But if you have good credit, you can get under 3% for 30-year fixed. That's amazing,
That's
unbelievable. I never
that's
thought that
awesome.
I'd ever see that in my life. Yeah,
That's awesome. That's a good opportunity for home buyers or
it
even
is.
yeah, for
Oh
refinancing.
yeah, I mean that's why it's making it so popular. People are buying up, and people are refinancing if they're going to stay in their house. You know, I mean, I just refinanced Cameron the other day, and you know he'll never refinance his house ever again.
Awesome. Okay, I
So
think we
yeah,
can start. Yeah, just go ahead and explain for us what's the financing process from beginning. Like somebody calls you and say, okay, I want to buy a house, what I'm gonna do, what I need to do. If you don't mind, just go from very beginning.
okay, all right. So basically, the first thing when I'm talking to somebody on the phone when they inquire about a mortgage is we start talking about if they know how much they want to spend. If they don't really know how much they're going to qualify, then we'll back into that. And how I do that is we start talking about their income and their debts and stuff like that. And I find out how much money they have to work with, because that's going to determine what kind of loan they go with, whether it's a conventional or an FHA, or if they have VA eligibility or something like that. And we'll come back and talk about that in just a minute. But so we kind of go through that process, and I'll talk to them about do they have any idea what their credit looks like, and if they know their credit score. Sometimes a lot of people have been online and looked at Credit Karma or something like that. Credit scores and what they look like on Credit Karma, and what they're going to look like when I pull their credit report, because the credit scores are not going to be the same when I pull them versus if they get them online from Credit Karma, because we just don't, in the mortgage industry, uses different algorithms than say Credit Karma or freecreditreport.com. There's nothing wrong with getting your credit score there, but you're not going to get an accurate credit score as far as a mortgage credit report goes.
So
It'll be a little bit high.
what's the minimum credit score that you need?
Right now, 620. Right now, and that's been raised up since COVID has hit. It was down. You would go down to 550 in some cases before COVID, and we'll get back to there probably not until next spring, but we'll get back there. But right now it's 620. So you got to have a minimum of a 620 credit score, and you're going to be looking at, in on that particular situation, more than likely you're going to be looking at an FHA loan. So you need 3.5% down. So.
Okay.
That's the next step I'll go with the customer, is asking them, you know, how much, as far as how much money you have to work with, is going to dictate to me which way we're going to need to go with the mortgage. So if you have lower credit scores and not a whole lot of money to play with, then we're probably looking at an FHA loan. If you have high credit scores and say, you know, 680 or above, and not a whole lot of money to work with, then we may look at a 3% conventional type of loan. And if you were a veteran or an active duty veteran, then I'm going to talk to you about VA eligibility. If you have VA eligibility, you can get a 100% loan through VA. So we kind of go through the different programs, because there's different programs. If you buy outside of the city of Louisville, you could potentially get a USDA loan, which is 100% financing.
Wow.
But again, all that's going to depend on what you're looking at doing and where you're looking at buying and so forth.
So your company does that kind of loans out of the Louisville area, right?
We do all through Louisville, over southern Indiana, well, all over Indiana. I'm licensed in Indiana, all of Kentucky, and I'm actually licensed in Florida too. So people buy, because I have customers that buy homes, second homes in Florida quite a bit. So yeah, we offer all those loans in all of those states.
And that's Partners United Credit, or what's the
Partners United Financial.
Financial? Okay, yeah.
Partners United Financial. Right.
All right. So you check on income and credit, then how much money, is it matter how much money they have on their account?
In their bank account?
Yes.
The more the better. But it not always. But again, depending on how much they're planning on putting down on the, you know, on the home, there are some programs where you can get some down payment assistance out there. But you know, the more money that you have in your bank, the easier it's going to be to get the loan. Gotcha. Because they're going to have more skin you have in the game, the easier it is. The less money you put down, the more scrutiny you're going to get as far as an underwriter is going to look at your loan.
So basically, that's the first step. So before anything, you need to know what's the income. They need to have like a solid income, any kind, and a good credit.
Right. Well,
then
the income is really important.
Okay, then you can give a pre-approval letter, right, based on these.
That is correct.
Without any pulling credit, nothing, right?
No. To get a pre-approval letter, I've got to pull credit. I've got to check credit, because most people don't really know what their credit score is. Sometimes they think it's really good and it's not so good, and some people think it's bad and it's a lot better than what they think. So I don't issue credit pre-approval letters without pulling a credit report. So I've got two different letters that we'll give. We give a pre-qualification letter and a pre-approval letter. Oops, sorry about that. Just to kind of give you on a pre-qualification letter, I'm going to pull your credit and I'm going to take your verbal information. All right, we'll talk through it. A pre-approval letter, I'm going to pull your credit report. I'm going to get all of your financial documents.
Okay. So how long it takes for you to give a pre-approval letter?
Same day.
7 days?
No, same day. Same day you send me your documents.
Same day. Okay, that's awesome.
Yeah, I can do it. I can do it just in a few minutes. I've already verbally spoke, so I'll have the information. But for me to give you a really good pre-approval letter, I need to see the documents. And the reason that is because people will give me their income, and until I can actually see their pay stubs and their W-2s and stuff, there may be some income that they're counting that I can't use, such as overtime or bonuses, and I can't use those unless those people have been on the job for 2 years. Commissions is another one, and I need a 2-year average there. So that's what I want to make sure that we're not going to run into problems down the road after we've already signed a contract. So that's why I do it that way.
It might, a lot of immigrants watch this video later on. How many tax returns at least need to somebody have to apply for a loan?
Maximum 2.
Okay, 2. At least they need 2 tax return years, right?
Yes, you need 2 years of tax returns, right?
Gotcha. All right, so let's go move forward. Let's assume the buyer gave you all the information and got the pre-approval letter. They went with the agent and checked an house and put an offer, and the offer is accepted.
Okay. So at that point in time, we'll start talking about interest rates and locking in an interest rate. Okay. And once you lock in an interest rate, I compare it to buying a tank of gas. Once you buy the tank of gas, no matter what happens, you've bought the tank of gas. If you're going to work and you buy the gas and it's $2.50, and you go to work and you come home and it's $2, you don't get to go into Thornton's and ask for your money back. In the same way, if you buy it at $2.50 and you come back and now it's $3, so but we talk about the interest rate and whether we want to lock a rate in, and then if we will also talk about the home inspection, because we need to do an appraisal, but I don't want to do the appraisal until after the customer has their home inspection and negotiates out any repairs just in case the deal would fall apart during that, or maybe they find something about the house that they really didn't like, because the appraiser doesn't work for me or my company. They're an independent appraiser, and if they do the appraisal, we have to pay them, and well, the borrower pays
Right.
them. So I always hold off on that. So I will move forward with the loan and push the loan forward, send out all the disclosures to the borrower and stuff like that. But I hold off on the appraisal until after the home inspection is taken care of, and then after that's taken care of and everybody's happy there, then we'll order the appraisal and then we close.
Okay. Do you discuss about the closing costs?
Yes. So your closing costs, closing costs are going to consist of your appraisal, your title work, your title insurance, recording fees. We have there's different companies called their fees different things. There's processing fees and underwriting fees and stuff like that. But typical closing costs on a $200,000 loan is going to run around $3,400, something like that. Now, on top of that, you've got escrows, taxes and insurance, prepaid interest. Okay, so you're going to have to pay when you buy a house. You're going to have to pay your insurance company up front for 1 year. So you're going to pay them, say, from July 2020 to July 2021. And then we're going to set up an escrow account in most cases where you're going to put 1/12 and one of your insurance and 1/12 of your taxes into an escrow account. So when those come due the next year, we'll be able to pay them on your behalf. So we've got to set those up. And again, on a $200,000 loan and say a $250,000 purchase price home, you're probably looking at somewhere around $2,900 on something like that. So, you've got $3,400 of closing costs and another $2,900 in escrows, plus your down payment.
Okay. So basically it's about typically for 200,000 house, basically they need to come up with around 6,000 something.
Right.
Plus
that's correct.
down,
For
plus
closing,
down
plus the down
well.
payment. Right. So depending on how much they want to put down, if they want to put minimal down, 3% or 3.5%. So you're looking anywhere from $12,000 to $15,000.
Okay, great. So that I think that's the whole process. I just want to summarize. Then we can talk about the different loan types. As I get from your what you said, after you check the income and their credit, you're gonna give a pre-approval letter. Then as soon as we send an accepted offer, you're gonna lock the interest rate and maybe send out an application to sign by the buyer, and basically discuss about the closing costs, which for a typical 200,000 house would be around like 3,300 for closing costs itself, and around 2,900 for escrow, like for insurance and tax, right?
Correct. Yep,
Okay.
that's pretty much it.
Okay, so could you please, I guess we can talk like 8-10 minutes about different loan types. If
Sure.
you can just explain what kind of loans we have in market, and what's the difference of, secondary market, banks, financial brokers, all those kind of stuff.
Those are great questions, and I talk about those every day with people. So there are certain categories of loans. Okay, you have, say you want to buy a home, flip it, and turn around and resell it, or you want to buy a home and rent it. Maybe you want to fix it up and rent it. And you've got a big rental portfolio. Well, typically what you're going to be looking for there is what's called a portfolio loan. And portfolio loans are mainly done by small local banks for the most part. That's not exclusionary, but it is, by the most part, it's your small local banks that will do those type of loans. And they have their own guidelines, and they don't adhere to the same guidelines as my loans do. They have higher interest rates and higher down payment requirements. They're going to require probably 20 or 25% down or something like that. But they're a little bit easier to get as far as loans, as far as guidelines and stuff go through. Then you've got some Alt-A type loans that are out there. that are they don't fit the perfect secondary market loans. And when I'm talking about secondary market loans, and we'll get into a little bit more details on those, those are the loans. That's about 90% of all mortgages seem to be going to the secondary market. That's where the conventional, the FHA, the VAs, the USDAs are. But there's a whole other market out there called an Alt-A market, was what I've always called it. And it's for people who don't fit the secondary market, but they have really good credit. They have good income. Maybe they're self-employed, and their business tax returns don't show all the revenue. They don't show as much profit because they've got a lot of depreciation or whatever the reason may be. They just don't show a lot of profit. We have programs, or there are programs out there that will look at bank statements and stuff like that. So it's just a whole different market that fits loans that they just have income streams and stuff, but it just doesn't. It's not the secondary market. And those loans, you can get those through. Some banks have them. Some larger banks have them. Mortgage companies such as ourselves, we have those. Other mortgage companies have those type of products too. And then you've got the secondary market loans. This is the biggest and the most popular loans out there across the country. And that's going to be for your conventional, your FHA, your VA, and your USDA loans primarily. So a conventional loan, you probably have heard of Freddie Mac and Fannie Mae. They're the purchasers of most of these mortgages, or a large portion of them. So they set the guidelines, and basically you have to follow these guidelines. And these loans are sold on the market. Pension funds buy them, stuff like that. And so everybody has to follow pretty much the same guidelines. There's a little bit of nuances in each and every company, but for the most part, we all follow the same guidelines. Conventional loans are going to be for people who have higher credit scores. They're going to get really good interest, best rate. The higher the credit score you have, the better rates you're going to get. Okay. Then you've got in that same secondary market, you have. Say again.
Hey Shane, can you say it again? Your voice is broken. Unconventional loan. But you said you need.
Well, on a conventional loan, is typically going to be for the borrower who has really good credit scores, and so you don't have to have a whole lot of money down, but the more money you have down, the better credit scores you have, the better interest rates you're going to get, for the most part. Okay. And then we will shift over to an FHA loan. Now, an FHA loan is not a bad credit loan. Don't get that at all. They have some more flexible guidelines on a few things. We don't need to get into details of those, but they will also help people with lower credit scores. Sometimes when you're young and you're just getting started, you're out of school, you don't have a lot of credit history, your credit scores are low. Not because you don't pay your bills, but because you just don't have a long credit history. Your credit scores are low. So we'll put a lot of those people in an FHA loan for their first house. So it can go all the way down to a 620 credit score right now, and you can go lower in some cases in those, just not at this moment with us. They have low down payment, 3.5%. So there's a lot of flexibility there with the FHA loan. We do quite a few of those. And then you have the VA loans. But to qualify for VA loan, you need to be a veteran or an active duty military and have VA eligibility. And those are good loans. You can do 100% financing on those loans. If you have any disability whatsoever through VA, there is no VA funding fee. So that's an insurance that basically insures the lender a portion of the loan in case you don't on that. Heard of any disability, there's no mortgage insurance is basically what it means. It's a really good deal for the veterans. And then the other loan for veterans, veterans or active duty military. And then there's another loan out there called a USDA loan, or rural housing loan. You have to be in the outlying counties. It can't be in Jefferson County typically. You have to be out in Bullitt, Oldham, Shelby, Spencer, or out somewhere else out in the state of Kentucky. or Southern Indiana. But those are 100% loans as well.
So it doesn't apply for Jefferson, you said? Jefferson,
It
Oldham?
doesn't. It does not. Yeah, it does for Oldham, but just not
Oh, it
Jefferson.
does for Oldham, but not for
Not for
Jefferson.
Jefferson.
Okay.
Right.
So what's the condition of the USDA loan? Is it
Well, you've got there are some income guidelines or some income limits that you can have on a USDA loan, and they vary per county, but it runs around I want to say high 80s, low 90s in our market here, depending on what county.
okay? Great, Shane. Thank you being with us tonight. Thanks for
Absolutely.
your
Thanks for having
time.
me.
Again, thank you, Shane Gilmet from Partners United Financial. You gave us
Thanks, Austin.
great information tonight. Thank you. Appreciate it.
All right. Bye-bye.
Have a good night. Bye.